It's here, as always. I appreciate those that keep supporting these daily Spaces conversations, which I do as a solo effort. Please, folks, also do me a favor and rate and review that, which means give it 5 stars. So, with all that said, my name is Michael Guyette, publisher of the Lead Lag Report. And joining me for the hour is Mr. James Lavish, who's got a lot of interesting macro thoughts. We'll talk about Bitcoin, debt, and anything else that kind of comes up here. James, for those who are not familiar with you, introduce yourself. Who are you? How'd you get involved, interested in markets? And what exactly is a reformed hedge fund manager?
That's a good question. So thank you for having me, Michael. I've been following you for a while on Twitter now, and I appreciate meeting you and having a conversation. So this is good. Who am I? Well, yeah, I'm a reformed hedge fund manager. I mean, I've been an institutional investor for nearly 30 years. I hate to admit, I've been in hedge funds and private equity for a long time. I started out on the floor of the New York Stock Exchange. You know, trading EDR arbitrage is something that there's an arbitrage between trading foreign securities on a local exchange because of stamp taxes and the foreign currency exchange rate and all that. So I started doing that and just kind of migrated into a life of arbitrage and then private equity and hedge fund investing. So before that, some of your listeners who already follow me may know that I was a hockey player. And so to be truthful, Michael, I thought that I was going to be a professional player. I got hurt just as I was coming out of college. And so that blew up. And that's why I went to the floor of the New York Stock Exchange to make money, to pay off loans. And it was it was fun because I went straight from that world of super high intensity, fast decision making. And it's not really the decision you make as much as it does matter, but it's not really that as much as how you react to it. So, and so I was used to working in that high level of intensity with a lot of pressure and making quick decisions, a lot of eyeballs on you, and it worked out fine. And I just stayed in that world. So how am I reformed? Well, I'm here. I understand what Bitcoin is. I understand why we need it. I truly understand why we have a broken financial system, and not just in the United States, around the whole world. The fiat system is problematic, and it's laden with massive amounts of debt, and it's going to put tremendous pressure on not just those who can't keep up with inflationary pressures, but the whole system, because of the sheer amount of debt that we have across the world. So that was a long intro, but that's kind of who I am, and I'm happy to be here.
How has the hedge fund space, the private equity space, changed post GFC? Right, because I'm sure you've seen all the same stats on this. You know, hedge funds used to be able to generate alpha. You know, there was that old Bloomberg cover where there was the perception of hedge fund managers, and it was coming from the crotch, right? It was an arrow up. And then the reality was, was more flaccid, like a better way of saying it. I'm curious to hear your thoughts on why is it that hedge funds are not sort of the easy winner or easy choice to be a winner going forward?
Yeah, that's a good question. I mean, when I started getting into hedge funds back in 94, 93, 94, we were literally the bastard child of the industry. People didn't even know what we were doing. They were like, hedge funds, what, you're long and short, you're pair trading, you're arbitrage. Like, what does that mean? All the big accounts, they just wanted to cover, so let me back up. So you've got the buy side and the sell side in Wall Street, in the institutional investing world. And Michael, you know this, but for some of your listeners who haven't heard this before, you've got people who cover these accounts, and they're called sales traders, and they feed them research from their houses, whether it's Merrill Lynch or Goldman Sachs or wherever it may be. And so they get paid for feeding that research and facilitating and executing trades. And these are big trades. They're 10,000, 100,000, million shares at a pop. And so they're big commissions. Well, when I came out, hedge funds were kind of a little bit unknown. I mean, you had the worlds of the Ivan Boesky and the Michael Milken. That interaction went pretty sour, and a lot of people got in trouble. And hedge funds were kind of known as, they were a little bit not shady, but they were just like, you just couldn't figure out what they were doing. So we actually struggled. The first hedge fund I ever worked for was within Travelers Group. It was, you remember Sandy Weil, who's CEO of Travelers Group, goes on to become the CEO of Citigroup. And one of his star investment bankers, Jamie Dimon, left because Sandy Weil made his daughter the head of the investment group there at Smith Barney instead of Jamie Dimon. The rest is history. But long and short of it is, we couldn't get coverage. They didn't want to cover this $1 billion hedge fund who they just didn't understand what we were doing. And so we had to get prime brokerage coverage within our own house. Which was Smith Barney, which was owned by Travelers Group. So flash forward to 1998, and just a few years later, and the industry had just exploded. And so you had these hedge funds with massive amounts of money. And really the turning point, Michael, was long-term capital management in my mind, where you had this hedge fund that was run by a couple of Nobel Prize winners who had come up with Black-Scholes and the Black-Scholes option pricing model. And those guys, they thought they were so smart, which they were, but they were using these models that they back tested for maybe 100 months instead of 100 years. And so they were basically shorting volatility, and they were leveraging up against that. They were using all of these prime brokers to leverage. So just a few years earlier, we could barely get coverage. Flash forward to the days of long-term capital management, they have $1 billion under management. And it doesn't sound like a lot of money today, but it was back in 1998. And they convinced, they had all these prime brokers. Okay. So what's a prime broker? For your listeners, that's the broker that custodies and gives leverage to the customer, so the client, and the client would be the hedge fund. So it would be no different than having an E-Trade account, except E-Trade gives you, $1 billion of leverage. So these guys convinced all of these huge investment banks and prime brokerage units to give them massive amounts of leverage. And they were levered 100 to 1. You had the Russian ruble crisis. You had some word got on the street that these guys were short volatility and interest rate arbitrage. And so you had other hedge funds piling on, taking the opposite side of that trade. And it blew those spreads out. And long-term capital management threatened to take down the entire financial system. How? Well, because they had so much leverage again on the other side of all of these banks that Goldman Sachs had called an emergency meeting with the New York Fed and begged for him to come up with some sort of financing deal with the other prime broker, the other investment banks, to bail them out. And he did. And so that was kind of the start of this whole, Cantillon effect and money printing and, QE. That was kind of like the start of it in my mind. You can go back to 87 with Greenspan, but this is kind of where we really cemented that we're going to make sure that these banks are just too big to fail. We're not going to let them fail. And how does that feed into the hedge funds? Well, hedge funds started we started all talking to each other. And we knew it wasn't inside information. We just knew what we were doing. Like, are you guys buying this? You're buying that? Like, we knew what other hedge funds were doing and what their trades were. And so we were all doing the same shit, and that started that we all started to have this correlation that if you go to look at HFRX index or the HFRI index, you can see that hedge funds struggle to make money. And here's the funny thing, Michael, these are the ones that survive, right? So you have a survival bias to these numbers as well. And most hedge funds that start out don't make it. In the first number of months, they just have the operating costs are too high and they just don't make it. So it's even worse than it looks on paper.
I never thought that LTCM was sort of the start of true moral hazard, but it does make a lot of sense. Even if you were to argue that when Greenspan lowered rates after the 87 crash, that was sort of the start of the Fed as a moral hazard. Force. I mean, that's on the entire market as opposed to a single institution.
Right. It was so explicit. I was getting phone calls, and some of you people in here have heard this before, but I was getting phone calls at late at night, and there were other hedge fund managers were like, "Hey, do you guys have exposure to Goldman? Are you using them as a prime broker? Because if you do, you better move all of your assets now because they're going under tomorrow. And it was nuts. And they were in that boardroom for hours that night, and they came out, and it was just, you know what it was, Michael? It was explicit. It was just explicit. We're just not going to let this happen. And that was a new thing for me. I mean, and I'd only been on the street for what, 6 years at that point, 5 years, but that was, wow, eye opening. And it was pretty traumatic. It was pretty scary. We thought the whole world was on the verge of collapse. So, and it kind of was.
Yeah, and of course back then we had a government surplus, right? So,
Right.
so if we draw the line to that sort of the start of moral hazard, the question then becomes, where was the start for modern monetary theory, which got us to the debt position that we're in, right? So I'm going to argue, and I've made this point before, that everything can be ultimately traced back to the Iraq War. And I'm talking the second Iraq War.
Yeah, I want to hear this.
Post 9/11.
Yeah, I want to hear this.
Right, and I've made that argument because I find it oddly coincidental that the estimates are that the Iraq War cost around $8 trillion, since we got in, and that's roughly the size of the Fed's balance sheet. When the towers came down, one of the first things Bush said, and all of the government said, is, "Don't worry about it. We got to keep spending." And I think that was sort of the turning point culturally, where we abdicated responsibility to the federal system and resulted in the idea that we can keep on borrowing, keep on spending. The government can do whatever it wants, unchecked, no austerity, who cares? We have to fight this war on terror. And it just sort of fed it on itself. And I'd even argue that even led to the conditions that ultimately got us to the GFC to begin with. But where do you think sort of we got off the rails from a government fiscal standpoint, from a Fed standpoint? It's more than just LTCM.
Yeah, no, I think that was not where it's not where the Fed stepped in. It's the Fed gave them all a backstop. The Fed said to the New York Fed was just like, look, we're going to backstop you guys. If you bail out Goldman, don't worry, we have your back. And that's where kind of just that signal. But you're right, the Iraq War, I mean, we spent god awful amount of money on that. And so, flash forward to the great financial crisis, and of course, we printed so much money to bail these guys out. It was insane. So that's really where the irresponsibility started to show, and it manifested to a point where I believe that there's just no return, right? So, I mean, if you look back at our debt to GDP ratios, we were getting it kind of under control. Not under control. I mean, it was not out of control back in 2000. I mean, you can pull up the U.S. debt clock and see it right on there that it was just under 60%. It was 59%, and now we're at over 120%. If you include everything, local and state debt, it's 134% debt to GDP. So, what's the problem? Well, I mean, it's pretty simple. I like to simplify things, Michael. I like to keep things simple, not make people think that we're smart because we know all these fancy terms. But so if you bear with me, I like to simplify things as much as possible for everybody to understand. And the simple fact is the U.S. Treasury spends more than it collects. It doesn't make money; it collects it. It collects money from people who make it, the people who produce. Right. So for everybody to understand, the problem with debt to GDP being so high is that GDP it's the indicator of what those tax collections are going to be for the Treasury. And so we're spending, the simple fact is we're spending $1.4 trillion more annually now on a go rate today than the Treasury collects. And that's problematic. It's problematic for a lot of reasons, and we can get into the debt spiral and exactly how this goes forward. But it's simple. We've printed too much money. We took on too much of that debt. We've monetized that debt. Now we have to pay interest on all of the debt that's out there. And those interest payments are pushing us to higher and higher deficits. And it's a spiral that we just can't get out of.
I wonder, though, if that's sort of a natural situation that happens with any developed economy. If it's not just sort of a question of fiat, if it's just a question of what happens in the natural process of time.
It's irresponsibility, right? But look, I'm not against debt. I think that debt can be very helpful. I mean, debt pulls forward, it pulls forward future productivity. How? You borrow money and you produce something and you pay that money back. Like if you want to go start a restaurant, you can't just start a restaurant with the money in your bank account unless you have a nice little nest egg. You can start with a little bit, and then you borrow some money to start that restaurant. Well, so you borrow the money, you start the restaurant, right? You buy all the supplies you need, you buy all the materials that you hire the employees, and you start generating revenue. And that revenue is GDP. That's part of GDP. And you're paying back, as long as you're making more money than you're spending on your debt that you borrowed to make that restaurant. Well, you are adding to you're being additive, right? As long as you don't over leverage yourself. Well, so debt can be good. And I would argue that debt has enabled us to grow super fast, really rapidly in the United States here. But we've gotten over our ski tips. We've spent too much. Our entitlement programs are, we spend so much money on war. We spend so much money on defense. Some of that is absolutely needed, no doubt about it. But we're not very good stewards. And it's just it's a structural issue in my mind. Long ago, when I was an undergrad, I argued for term limits in Congress. And the fact that there's really no limits on spending for campaigns, there's backdoors for all kinds of campaign contributions and PACs and whatnot. None of the politicians nobody is incentivized to fix this problem in our government, because we can always print more money. And being the global reserve asset with the Treasury, we have that luxury that we can just do this ad nauseum, forever, and until we can't, obviously. So this is, again, another long-winded answer, but the problem is structural. We don't have anybody in place who's in charge of this balance sheet that has incentive to reduce the spending on it. If you reduce spending, it impacts your voter base. That's no good. If you raise taxes, it impacts both your voter base and it negatively impacts your gross domestic product. So that's no good. So what's the other solution? Just issue more debt. It's easy. Raise the debt ceiling, issue more debt. All these semantics we have going on in Washington right now about the debt ceiling and they're going to raise it. The question is by how much, and what are the concessions going to be that the Republicans demand from the Democrats? Both. Remember, neither of these guys are on our side. Neither of them. I liken them to the two hockey teams, and I did this my whole career, where we would go out, we would literally fight each other on the ice, literally fight each other to win. And then after the game, we'd all be at the same bar, drinking the same beer and hugging and laughing and high-fiving. We're all on the same team. It's a big show, period. And so that's what it is out there. And everybody has to understand that. And so I feel like yours and my job is to wake people up to understand that inflation is hurting them and we have a choice. And so that's why that's why I've gravitated to Bitcoin, because I believe that it can fix not all, but many of the problems that we have structurally and fix the money.
Yeah. And to your point, a lot of that is around incentives. I do wonder, though, if, just going back to the debt to GDP being as high as it is, if we're not necessarily at that point of no return. I'm sure you've seen the same sort of things that I have. There's a degree of cronyism and inefficiency when it comes to government spending, which then obviously translates to the debt side. Toilet paper costing $800 a roll, right, for the military, as an example.
Right.
As a small example, but cumulatively, you can see how things like that can result in obscene spending. To me, the answer has always been much more around legal aspects to limiting some of this kind of behavior, some of this debt, right? Having constitutional amendments. I know the Bitcoin maximalists would say you have to really do it at the heart of it with the currency side. But why are laws not sort of the solution to this debt problem?
Who's going to pass those laws? They're the legislators. They're the legislators who are not incentivized to do it, right? Look, let me be clear. I'm a probabilities guy, right? I'm not speaking in absolutes, but I do believe we have a high probability of the U.S. Treasury being unseated as the global reserve asset and the US dollar failing in the future. I don't think it's today. I think it takes a long time. I mean, this is what's accepted as money. It's accepted as the best form of currency in the world. You can use US dollars anywhere. Okay. So I don't believe that it just one day just collapses instantaneously. I think it's a long drawn out process. I think it takes a long time, but the reality is we are on a path that's just unsustainable forever. No. So if you can go to the Congressional Budget Office, cbo.gov, and look at their projections, and they are admitting, and these are kind of optimistic, rosy projections. They are admitting that the deficits just keep growing. They are admitting it. They don't have a structural way to fix it. And it's like we just discussed. You either stop spending. How are you going to do that? Entitlement spending is up. It's up another, I think, 8% this year because of the cost of living adjustment. So we just bumped over. If you look at a report that just came out, and it literally just came out a couple of days ago, and the new report comes out next week. I'm looking forward to having a bite at that. But the federal deficit in the first 4 months of 2023, right? So you remember we started in October for fiscal, for the government fiscal, right? So it was negative $460 billion in the first 4 months of 2023. And assuming we're in that right now, right? And it would have been over $500 million if it weren't for like this one weekend pushing some of the payments back into 2022. So, what's the problem? Well, tax receipts were down 3%. Total spending was up 9%. A lot of that was due to entitlement spending, and a lot of it was due to interest on our debt. And so, if you have about 50% of our debt coming due in the next 3 years, the U.S. Treasuries mature. As they mature, since we're in a deficit, we can't pay for the principal on that note. So we have to send the investors money that we are creating by issuing more debt. So that debt matures, and if it's at an average of 1.7%, well, now you're issuing it at 3.5% to 4%, right? So the spending, your interest costs just simply goes higher, and we're starting to see that manifesting on the budget right now and on the balance sheet. And so that's going to continue to happen. We're going to continue to have this debt roll off and then get put on at a higher rate, raising our interest expense every single year until the Fed lowers rates. And so, but now we're in a problem where the Fed knows we have like structural inflation issues, right? And so there's a lot of things going on. There's a lot of noise, but the Fed understands we have structural inflation issues. They need to keep rates high enough to tamp down that inflation, right? Because they can't let it rip out of control. If we have super inflation in the United States, that would be something that would tip off a major problem in the treasury markets, right? So,
well, I'd argue, by the way, history has shown us that when you have hyperinflation, those are the conditions where you have despots.
Sure.
You wouldn't have Hitler if you didn't have the Weimar Republic.
Right, sure. But okay, but if you have 15 to 20% inflation in the United States, you're going to have revolt. Like you'll have a lot of structural issues. Social issues will pop up like that. People will be revolting. So going back, the problem is the Fed can't be Volcker because they can't with debt to GDP at 130%. And what I just described, you can't raise rates to 18, 20%. It's just, you would blow up the balance sheet immediately. It would be traumatic to the Treasury, right? So the Fed can't really do that, but they can hold rates higher for a while. And they can kind of hide what the inflation really is. Everybody knows that you go out to the grocery store, you know that you're paying a lot more this year than you were for groceries last year, right? And they could show CPI at 6.5, whatever it is. There are some adjustments that websites are doing to show what the real inflation is, and it's hard to put an exact number on it. I would guess it's much closer to 10% or even higher now. But there's a little smoke and mirrors going on. They're changing what's in the basket, that they're adjusting what, from period to period, what the marks are. And so there's a lot of adjustment going on. So what do they need to do, Michael? Well, they need to continue to have inflation. Why? Because they need the real rate to be negative. Why? Because that helps pay down the debt. If your nominal GDP goes higher, meaning just in pure dollar terms, because of inflation, well, they're literally paying off old debt with cheaper dollars. And they need to keep doing that. And they can do that for a while. And I believe they will. So GDP will continue to go higher and look a little bit better. The CPI, they're going to hold it. They're going to say that they've won. And the pivot, I don't know when that happens, but I do believe the Fed does pause here in the spring. I don't know how long they'll hold them, but I think they will hold them. They're a little bit longer, definitely longer than Wall Street was betting last month or this past month. But I don't think they're going to pivot immediately, but they do have to pivot at some point because of what we just described. However, I think that they're going to snow us a little bit. They're going to gaslight us a little bit on the inflation numbers, and they're going to let it structurally run a little bit higher, more like 4 to 5% in reality. And they're going to tell you it's like 3 to 4. And it's not going to be enough that people feel it enough to revolt, but I think that they're going to run structural inflation higher. And that's a good way for the Treasury to kind of just chip away at this massive pile and make sure it doesn't get completely out of control in the next 5 to 10 years.
Right. And not to sound cliche, but the end result of that is the middle class gets screwed.
100%.
Right? Because the very wealthy are going to avoid it.
Yeah,
right?
It eviscerates them. So you have two classes, and that's happening. Right. Sorry, Michael.
Yeah. And it's interesting. Like I've often kind of struggled with this question of if the idea of the middle class to begin with is a bit of an anomaly in America's history, because if you look at any other society over any period of time, over centuries, there is the rulers, the elites, and then everybody else. The middle doesn't really exist. I often wonder if it's kind of unavoidable that the middle class ends up just being lower class.
Yeah, that's a good point. And I'm not a historian, but if you look at it, you have double incomes now, and you have triple incomes in families, and they're not keeping up. And why is that? Well, because wages aren't keeping up. Why is that? Well, inflation is running hot, and they don't have to. So it's become normal that you have families, you have two working spouses that are just struggling to meet. There was a statistic that came out last week, and I can't remember exactly what it was, but I believe it was 61 or 62% of Americans who are making over $100,000 a year are living paycheck to paycheck. Now, let's back up a little bit. I'm going to argue that we're not the most responsible society in the world, but we're, the United States demographic, we're a little bit entitled. We want our takeout, we want our Ubers, we want our Netflix. Everybody wants to have these things, and they compare themselves to the guy next door, and social media has only made that worse. I'm an old guy. I'm over 50. So I remember the days before social media and thinking that every single person on the fucking planet was living in Bora Bora, or taking vacations to Paris weekly and drinking champagne and wearing all the beautiful clothes. You didn't have that when I was a kid. And so now you have this. There's so many issues here. We can unpack this so many ways, but there's pressures, and you feel inadequate if you don't have all those things. So you buy those things. You think it's going to make you feel better. I think we've become irresponsible, and I think that inflation has hurt us. And so it's problematic in a number of ways.
I've ranted on this for a while, but the reality is attention spans keep getting shorter and shorter because we're getting more and more distracted by things that have nothing to do with real life. I've joked before that, I think a lot of the excitement, we can debate this, around metaverse and, sort of a digital life is escapism, because there's no hope around the real life for a lot of people, which I think is, if I'm right, is a very sort of sad state of affairs.
No, think about it during the great financial crisis. Okay. So my wife is an author. Okay. She wrote a number of books, and her genre took off. Right. So her friends who were writing vampire stuff. I mean, okay, so my wife wrote some dark superhero stuff, not like Marvel, but more like urban superheroes. So people who had superpowers, but it was pretty dark and violent. So, but great stuff. But her friends who were writing the vampire stuff, we just kept remarking, we're like, oh my God, this stuff will not end. Like the vampire genre was nuts. It was like a wildfire that raged out of control all the way through every single publishing house. All they wanted is vampires, vampires, vampires. Her publisher, her agent was saying, just go write some vampires, please. She's like, I don't want to. So, but the problem, why is that? What's the point? Like, why was that happening? Well, vampires are a little bit romantic, but it's complete fantasy. So people were just trying to escape the reality of this life sucks right now financially. My job sucks. I'm underwater on my house. I can't make my car payments, and it was the great financial crisis was nuts. But that was one thing that happened was people were just trying to escape, and they turned to those complete fantasy genres. Now, flash forward to today, and what do we have? I went to the movies the other day, Michael, and I don't normally go because I feel like I waste so much time getting to the theater, sitting in the theater, waiting for the previews. But man, I was in there for 3 hours for an hour and 40-minute movie. And about 40 minutes of that was up front, the previews for all the new movies. And it seemed like, I think every single one of them was a superhero movie. So now we're back into like, everybody just wants to be a superhero. Everybody wants a superpower. And it's complete escapism. Like, yeah, I think you're right. And we're distracted. We have no attention span, and we want to pretend we're something that we're not, instead of just buckling down, focusing, and getting some of this work done. It's a wild dynamic.
Just for the remaining minutes here, everybody please make sure you follow James Lavish here on Twitter, and obviously check out his various podcasts. As you can tell, very thoughtful in the way he thinks about the world. If any of you want to come up, ask questions, click that bottom left mic request button. And as always, I will have this as a podcast under that Lead Lag Live banner. Please, folks, do me a favor, spread the word. It's always appreciated given that I do this daily as a solo effort. Okay, now I want to relate all that to Bitcoin now. I wonder if that short-termism, if that escapism is a detriment to Bitcoin as a solution. And I say that because personally, I think it's ridiculous when you have people out there saying that they expect Bitcoin to be at $10 million in 10 years. And it's not that it's ridiculous as a level, it's ridiculous that anybody can put a time frame around in general, that it's sort of get rich quick kind of thing. Do you think that kind of hurts the longer term adoption because it attracts the wrong kind of thinking around Bitcoin as a possible solution?
Yeah, I think it can, because it just seems surreal, like it's not believable, right? And you remember when the internet came out, and we were being bombarded with places we could go, websites we could go, and these merchants were starting to sell things online. And the last fucking thing you wanted to do was to put your credit card on this internet thing where you could just go and anybody could see it. Like, I'm not going to do that. And so people just refuse. You remember, people refuse to pay for things online. And now it's like, yeah, sure, I'll put my credit card there, whatever, But back then, that's why PayPal took off, right? Because it gave you one spot where you could say that they said you could trust us with your information, and if you pay through PayPal, then you're safe and secure. And I kind of liken it to that, where people are like, this Bitcoin thing, if I put my money here, is it just going to disappear? Like, what's going to happen? I'm going to put it on a wallet. What? Like, I don't understand. Is it a wallet or a signing device? Where is it held? It's just a lot of confusion and a lot of mistrust, and especially in this last year with the Celsius debacle and now the FTX debacle. It's just, there's so much distrust in this whole industry and I want to say the ecosystem, right? And all these protocols. And part of the problem is that it's very difficult to separate Bitcoin out from the rest of it because it's lumped in by mainstream media daily into all of it. And they say, crypto's down, look at Bitcoin. And so it's hard for people to separate Bitcoin out as a separate protocol that stands alone. And so I think so much of it is pure trust, and trusting that, and you put your money in this place and press this button, that you're going to get this code, right? You're going to get your key, and that's going to be the thing that unlocks access to that money in the future, right? And so people are just having a difficult time conceptualizing that. I think we need a lot of things. One of the things we need is signing devices that are simple, that people understand exactly how to buy and hold Bitcoin and spend it through Lightning properly without a problem of, losing your keys, being freaked out. I mean, I'm going to admit, I got into this space very late. I had ignored it. And here's a perfect example. And this is probably plays into, or this will probably help, play into exactly what you're talking about, Michael. I'm an institutional investor. I'm on Wall Street. It's 2018. I have some extra discretionary capital. I've heard about this Bitcoin a lot. I heard on Tim Ferriss's podcast. I thought, there's something to this. I want to check it out. And so what did I do? Being an institutional investor, you do what you would normally do. I go and talk to the experts, right? The experts are the technology analysts. These guys are covering Google and Amazon and Apple and Adobe. And I'm like, okay, so what is this Bitcoin thing? And I'm telling you, every single one of them to a T, not one of them had a different answer from, it's a Ponzi scheme. Don't trust it. It's worth nothing. It has no underlying value. You're going to lose all your money. Avoid it like the plague. Every single one of them. You know what I did? I avoided it like the plague. Like an idiot. I didn't think for myself, which I preach, critically think, I trusted the experts and I missed it. So I could have bought it at $3,500. Nice miss. So flash forward. Now my son, who's in college and he's in his 20s, and he's like, hey, and he knew that I was leaving my position during the pandemic. He said, Dad, you should check out this crypto stuff again. I think that there's something here for you with your investment background. And so I went back in and started digging in, and I've wound my way to Bitcoin. But the only way I did that was doing my own research aside. Like, I ignored all of the mainstream media articles and research on it. I did research on YouTube. I did research on Twitter. I read the white paper, and so I got an understanding of why it was different myself, but I had to dig in and do that. It was not something that was easily accessible, just laid out for you, I mean, we live in this bubble, right? And we have all these people that are surrounding us that all understand this protocol. We all understand why it's different. But I am telling you that when you go out to speak to a normal person out there who hasn't been orange pilled, and I'm not preaching to you, Michael, I'm just saying to the room, to the world, when you talk to somebody who is not exposed like us, who has not done the research, who does not understand it, it's a tall hurdle for them to get over. And they're like, oh man, crypto, everybody lost their money in that last year. And you have to start over the whole thing. Like, you're like, wait, hold on. Let me walk you through it. And I listened to myself the other night. I was telling somebody who's a pretty good family friend, and we're like talking about this. And he said, yeah, the whole crypto thing, I don't know. I mean, I've got some things, but I think it's all going to zero. And I said, yeah, well, I'm focused on Bitcoin. He's like, yeah, that's the oldest one. I'm like, okay, so that's all they know. It's the oldest one. It's the biggest one. It's what CNBC, it's what Bloomberg always quotes. That's all. And so I think, to answer your question, is we need a much broader and much more honest exposure of what this thing is. We need a much more honest exposure of what the energy usage is and how that energy usage can be turned to positives. And until we get a super broad understanding of this, and especially within institutional investors, they're still looking at it. Hedge funds still look at this thing like it's something to whip around. It's a tip of the spear of the risk assets. They move in and out of it ahead of all the other risk assets. And so until we get that understanding, until they understand it truly, then we're gonna have this massive volatility of both expectations and speculation. And you'll have sell-offs because it's just a herd mentality. And this kind of, it acts like a meme stock because that's what it's treated like out there. And so we're going to need this thing to be much bigger And the only way we're going to get there is to have a much broader understanding. I hope that kind of answers what you were asking.
So basically, everything can be summarized as few understand this. Is I think what you're. But it is interesting, right? Because listen, I'm a cynic. I mean, with a lot of things, you said correctly. A lot of people don't really understand Bitcoin. I'm going to argue a lot of people don't understand stocks. They don't understand bonds. They don't understand what it is they're actually buying when they're clicking a mouse button. They just think they're buying a chart as opposed to a piece of a company. Right. So there is a bigger issue, I'd argue, just taking the Bitcoin part of it out of it, in terms of, related to attention spans, related to education, related to what is the seriousness of where you put your money to work.
Yeah.
Right? I think that's sort of more at the core of the problem.
No, the core of the problem is we're not taught these things in school. We're not taught about finance. We're not taught about inflation, really. We're not really taught about it, And so that's one of the reasons I started that. I've got this newsletter, Michael, and it's called The Informationist. I take these concepts and I break them down super simply for people. Why? Because nobody teaches us these things. You hear acronyms, you hear terms, and people throw these things around and thinking that it makes them sound smart. Well, it doesn't make them sound smart. It makes the other person feel stupid. That's it. That's all it does. It doesn't help them. So the problem is we're not taught these things. You just hit on it 100%. People don't know that, a share of AMC stock, if you bought that thing, I don't even follow it because I think it's just it's disturbing. But if you buy a share of that, you don't realize that you're buying a share of debt. That's all you're doing. You're not buying anything that has any inherent value to it. Why? Because the balance sheet is upside down. Why? Because the company doesn't make money, and so, but people don't understand that. And they just buy things on momentum, on charts. They do TA, sorry, that's technical analysis. And some of that can be helpful, I think, especially in the short term, but you have to understand what you're buying. You're 100% correct. And that's part of the problem. We're just not taught these things. Look, the people who are in charge are not exactly, again, incentivized to make us smart about this, to make us knowledgeable. Why? Because they want to tell you, hey, look, I'll manage your money. You give me your money, I'll manage it. And don't you worry, you go about your day. That's why I know so many doctors who are investors, because they're smart enough, and it's not that anybody isn't, but they're smart enough that they're digging in. They have some money. They're like, I don't want to just hand it over to somebody. I want to figure out what's going on here. Actually, I could see Dr. Ross right next to me over here on in the audience, and he's a perfect example. He's like, man, inflation is eating away my earnings, and I want to figure out how to maximize my returns to beat that. And he got good enough that he's doing it for his career now, but it takes that kind of effort to get there individually. That's a tall hurdle.
Yeah. And I also do think it just like you kind of allude to the idea that you didn't look at it for a while because, colleagues, people you respected said, it's a little scam, don't bother. There's the other side of that too, which is you end up having the very loud ones, which are so pro Bitcoin that also can be a turnoff because it sounds a little bit too good to be true. Again, going back to these kind of forecast levels. So, the truth is always in between, right? The extremes, I'd argue. How do you think people should go about that journey of actually trying to learn about Bitcoin beyond just forecasts and podcasts? I know there's some very solid books, but you yourself, when you started going through down the rabbit hole, and just to be clear for the audience, I'm not anti-Bitcoin. Some people think I am because I was hammering on the narratives. I'm anti-narratives in anything. But how do you find the real truth behind the story?
Yeah, I mean, it's money. Study the money. Understand what's happening with money and how Bitcoin is different from the rest of it. That's what you have to study. Now, I'm not the guy I don't self-identify as a maximalist. I think that we need an understanding to grow, like you're talking about, for people to dig in and that's why I post things like people should be pissed off about inflation and they should be figuring out how it's impacting them and what they can do about it. And, one thing you can do is you can buy things that are stores of value, long-term stores of value, like gold, like silver. Silver's not, it's not the best because it's a useful commodity in industry. It's an industrial metal too, but, just buy things that can help store your value. I do believe that Bitcoin over the long term it will be the best store of value that we've ever seen. I believe that long term, it's not the best store of value if you need your money in the next 3 months. This thing is volatile, so that's.
But by the way, and I'm glad you say, because this is, so you're exactly right, and this is why I've always had a problem with wording and definitions. It's like all throughout the advanced, people kept on saying it's a store of value now, and I always go back to, you can't have something that's a store of value if you can't predict the path perfectly, which means it can't have kurtosis, can't have tails. It's got to be something you can rely on. So this is what I'm saying about narratives. Like the idea that it's a store of value now, who knows who it is down the line? Okay, I'll admit that as well. But the problem is, if you create that sense of confidence that it's in quote safe, which you and I both know is not, in terms of the sequence of returns, right? Not the counterparty risk. Well, that causes people to be overconfident, cause leverage. And I've said many times before, when it comes to the cryptocurrency space in general, the problem is not the underlying technology. The problem is overconfidence, which leads to leverage, which leads to crashes, which then delays the adoption everybody wants to see.
Yeah, that's fair. And then, the overconfidence even doubles because you have people who are on these exchanges and then using Bitcoin itself as the collateral to this leverage, which, that's just insanity. I don't even know how to explain how that is such poor risk management. But so circling back to exactly what you're saying, is the store of value. It's not going to be that true store of value that like an institutional level store of value until it has enough of a market value that these institutional investors can move in and out of it at 100 million, 200 million, $500 million, $1 billion at a clip, and not move that, the price of it. And that's what it's going to need, which means it's going to need to be hundreds of times that size, which means it's going to have to be trillions and trillions of dollars. It's going to have to be the size of the market value of gold, right? And that's going to take some time. I do believe we get there. I do believe we get to that understanding. And I do believe it's accelerating. We're in a trough period here of risk assets, and of course they've been handling this last number of weeks. But as we come through this recession that I believe we're going to hit, then it accelerates. But remember, it can be a store of value for a very short period of time in an emergency. If you're in Venezuela or you're in Lebanon and you need to move your money to something you can get out of the country with, well, yeah, that's effective. Definitely. It will be a store of value over a very long period of time, 5 years, 10 years, 20 years. I believe that. I truly believe that, Michael. Now, again, I don't have 100% of my wealth in Bitcoin. I think that's poor risk management. I cannot give you with a certainty 100% that this is going to be the protocol that overtakes the US dollar. The treasury as the reserve asset, but the US dollar is a reserve currency. I cannot say with 100% certainty that's going to happen. I do believe that probabilities say over the long period of time, 50 years, 100 years, yeah, I do believe that happens. But, until then, people have to be smart, allocate to it. You don't have to have that much of it to make a difference in your life. What I believe happens, which is this does increase in value dramatically over time.
Right, which you're hitting on exactly the point. I also keep emphasizing that, path matters more than prediction, and risk management is entirely about path. I think that's sort of the key point. I want to get to the question. Go ahead.
Sure. I mean, I just answered a bunch of that, but just to reiterate, I believe that Bitcoin becomes it is a very long term store of value, because I do believe it will increase in price for BTC over the period of time at a rate that's higher than inflation. I do believe that. But that we're talking, 5 years, 10 years for something that's more of a certainty for me than 3 months, 6 months, because it's volatile. And we are in a very uncertain period here with the economy and what is going on with the Fed tightening access to capital. And when you have liquidity tightening, that makes it difficult to predict what's going to happen in the economy. because sometimes these things happen like waterfalls or avalanches. So you're not sure. As far as money, well, as the Lightning protocol, as a Lightning layer is built out on Bitcoin, on the Bitcoin layer, on the base layer, it becomes much, much, much easier to use this as money. Now, it's going to have to be accepted everywhere. It's going to take time. But I think it's what the progression is. It becomes a store of value, and then it becomes it already is a form of money. You can use it. It's just not widely accepted. You can't use Lightning everywhere. And you can't spend Bitcoin everywhere. It's going to take time. But I do believe again that it does happen. So about investments, man, every single person in this room has a different investment profile. I'm a CFA, and I know better than to tell everybody to have a certain allocation to Bitcoin. Your allocation is your allocation because you have to understand your balance sheet. You have to understand what your liquidity needs are. You have to understand what your net assets are. You have to understand what your revenues are and your tax base is. You have to understand all of these things. You can't just go and say, oh, well, Joe's got a 28% allocation in Bitcoin. I should have a 20. No, you don't know how much money Joe has. You don't know how much capital he has at his disposal or what the liquidity is in his investments. He may have super liquid investments that he can tap into, which allows him to have a higher risk profile in his Bitcoin allocation. It's different for everybody. And if anybody who's saying, well, what should I be allocating to Bitcoin? Well, I cannot in good conscience advocate for anybody having more than just a couple of percent of this, unless I understand their balance sheet completely. And so you have to dig in and understand what your personal investment profile is. Please, people, please understand this. And if Bitcoin does what I believe it does, a few percent you will have more money than you know what to do with in the long future. But if it doesn't happen, so you lost a couple percent. Who cares? That's not going to impact your life negatively. I mean, it's the ones that worry me, or they go all in at a price, and you worry, well, we're heading into a recession here. I don't know what's going to happen to Bitcoin. It could double next month. I don't know, but it could go. It could have. I don't know. I don't have a handle on it. But in the long term, I feel better about it. I hope that makes sense, because I want to make that clear for everybody. Yeah, I think that regulation is essential for Bitcoin to be adopted from institutional investors to dig in and allocate it as a separate asset allocation. I think that we need that for that to happen. And
to control leverage.
Absolutely.
Again, I go back to it's like
absolutely.
The volatility is a function of leverage, so you've got to have limits on leverage. And I understand that's a global framework, not just a U.S. framework, but it's a start in the U.S.
Yeah, I fully agree. And so I personally think that some regulation will be positive, and it will accelerate the adoption. But it also depends on the type of regulation. If you get the White House trying to ban all Bitcoin mining in America, well, that could be problematic. I don't see how they do that, but the politicians they're jockeying in a lot of different ways. It's difficult to know. So yeah,
I'll add one final kind of offshoot. I was asked this question yesterday on a podcast that I was a guest on. The question was, if somebody wants to invest like you, what would you recommend? And my response was, why the hell would anybody want to invest like me? It's like, and I say that not some people will be cynical, because the reality is, even if you say you want to invest like Warren Buffett, you want to invest like Stanley Druckenmiller, like any of these, sort of gurus, exactly to your point, right? They are different biological makeup, mental makeup, psychological makeup than you as the individual. So to say that you want to mimic somebody else, to say that you want to have Bitcoin because some friend of yours has a high percentage, and has a totally different physical aspect to their personality and all this stuff, on top of exactly to your point, kind of their own financial profile, it's madness, right? People have to spend more time knowing themselves as opposed to knowing even their own investments.
So there's a great book called The Psychology of Money by Morgan Housel, right? And he goes through this, and everybody has their own risk profile. Everybody has their own, mental hangups about money. Everybody has their own approach to it, their own need for it. I mean, you have to understand all those things before you can decide what your allocations are 100%. The second thing is, You can't look at my allocations because, you may know this, Michael, but I'm about to launch a hedge fund. And so my allocations are going to be entirely different. Why? Because I can go and buy debt off of a distressed miner, public distressed miner that may or may not be secured by assets, and then use a delta hedge of stock against it. How do I do that? Well, because I can borrow the stock. I can get it through my broker to borrow it. I have an advantage there, and I know how to do it. I know how to do it in a way that limits my risk, that limits my downside risk, that contains it, and then it enhances my risk adjusted returns. Like you can't do that unless you have a vehicle that allows you to do that, and most people can't. So that's another thing. Like it's very difficult to look at these guys and hear what they're saying on TV, like you just said, Drunken Miller, Dalio. Like their investment profile is so complex. They have so many investments, and they've got this out on models and spreadsheets to know exactly what their risks are. And that I'm talking from the market risks, I'm talking economic risks, I'm talking dollar risks. Are they perfect? No. They make a lot of mistakes, and they misjudge a lot of things. But if they're good, they limit their downsides because they can do things that people who don't have access to certain tools and instruments and securities can't do. You can't buy a CDS. We talk about CDSs all day long. You can't buy a CDS unless you have $100 million to go buy a CDS. They don't trade in $10,000 clips. It just doesn't, that's not the way they are. And so you go buy Italian bonds and think you're going to go buy a CDS again. You can't. We can. If I had a fund that had $1 billion, I could easily go do that. But I guess I'm reiterating your point.
Yeah, and I think it's a good place to wrap this space up. From one CFA charter holder to another CFA charter holder, thank you for being a CFA charter holder, mentioning where Bitcoin fits in one's risk profile, because that I always go back to that point. I keep saying it: what you own matters a lot less than how much you own of it. I mean, it really is incredibly important, I think, to think about that weighting aspect relative to your own personality profile, investment circumstances, the whole situation there. Everybody here, again, please make sure you follow James Lavish. Check out his various interviews as well. And if you're an accredited investor, I'm sure he'd be more than willing to talk to you, given the hedge fund launch that he's doing. Thank you, everybody, for joining. Appreciate it.